All right, we're going to go through the balance of payments problem set. I'm really excited about this one. It's going to move pretty quickly. However, there's a great AC/DC economics video that I'll also send you the link for. Know that when we're talking about the balance of payments, we're almost always talking about the current account, which is like one and done type transactions. And then there's a such thing called the financial account. I cannot spell, so good luck with that. And these are like investments. So the other aspect of it is there's a such thing as a credit and a such thing as a debit. When you are debited, you're giving money to someone. When you are credited, you are receiving money. So when we talk about things like Boeing being a US based company, then we're talking about the US current account. When we talk about the idea that it sold an airplane, that airplane is the one and done thing. So that's how I know it's the current account. And because Boeing's a US company and it sold an airplane to China, the US received money, aka credit. A Chinese investor. So investor is kind of the giveaway here. I'll use green to try to demarcate that this is a financial account thing. The stock is kind of what gave it away as being a financial account related thing. So if the Chinese investor bought stock in Boeing, the Chinese financial account was debited, the Chinese account paid it. No matter what, we know it's a financial account, and the US account received money because the stock was bought. So the US account received a credit. The Chinese account was debited. All right, so just taking this idea just a little bit further, if a Chinese company bought a used airplane, that used airplane to me is the immediate giveaway that it is a current account thing. And because we shipped it to China, we received money from China. So this is definitely current account, no doubt about it. And we received money. So again, we got a nice fat credit for that one. The last one is a Chinese investor who owns property. This is like total red herring stuff, okay? We don't need to know that he owns property in the United States. Okay, he's just a Chinese investor who bought a corporate jet. That corporate jet is the same as every other plane we've been talking about, so it is definitely a current account. No doubt about it. So if it's a Chinese investor and he bought a corporate jet, then there's a very high likelihood he bought it from a United States company, and that would be a credit to the US or a debit to the Chinese company that he bought it from. So the next question goes into this Scotopia. It's a fictitious economy. It's going to ask us a couple of questions, and I'll try to take them piece by piece. This idea of a merchandise trade balance. I've never really heard this term merchandise before, but the trade balance is certainly the import, exports minus imports will give us the trade balance. So for that, in that context, it's 400 plus 300 minus 500 plus 350. If you're wondering where I got those numbers from, I'm adding the goods and the services that they exported, and then I'm adding the goods and the services that they imported. So the trade balance here is simply 700 minus 850. So when they're asking us the trade balance, I got 150 as the merchandise trade balance. Now take it a step further. What is the balance of payments on the current account in Scotopia? Well, the balance of payments on the current account is defined as your trade deficit. So it's the same exact situation. This is a redundant answer, but 150 is, negative 150 is the balance of payments on the current account. What is the balance of payments on the financial account? Well, the balance of payments on the financial account is equal to it. Essentially, almost every situation you'll ever experience, the current account plus the financial account is going to equal zero. So if the current account is negative 150, I can almost promise you the financial account has to be 150. That's how the balances pay out. So the financial account, the balance of payments, is a positive 150. Well, hold on, pump the brakes. You might tell me, David, why on earth did the teacher tell me that the whole world purchased 250 of this country's assets? When the world is purchasing financial assets, it's kind of like what China does to the United States. China is constantly buying the United States assets. When the world is purchasing assets in Scotopia, it's almost as if they're giving them money. So right now, Scotopia spent $150 more buying other countries' imports than it earned having their own goods bought by other countries as exports. So if they are in a $150 trade deficit, then the whole world gave them $250 to spend. So they overspent by 150. The whole world gave them 250. What are they going to do with that extra $100? Is they're going to buy assets from the rest of the world. So what kind of assets are they buying from the rest of the world? That's the difference between the amount of money that they were given, 250, and the amount of money they had in their current financial account. So $100 is the total amount that they ended up spending on assets from the rest of the world. So let's see if we can tell that story without looking at any of the math. All right, it's obvious 400 plus 300 is 700, 500 plus 350 is 850. So when we ask, what is the merchandise trade balance? And when we ask, what is the balance of payments for the current account? All we're talking about is exports minus imports. Then when they ask us, what is the balance of payments on the financial account? In that context, we're referring to the equation that says the current account plus the financial account has to equal 0. That's how I knew it was just the inverse of whatever I got on the first answer. Lastly, next it asks us, what was the value of the purchases from the rest of the world? This required just a little bit more information, and it's where I pulled the 250 back into the equation. I just took the answer from the financial account and I subtracted it from $250 billion. So that's how I knew if the whole world gave them 250, but they were in a position where they overspent $150 billion, they still had an extra 100 billion lying around somewhere. They used that on financial assets for the rest of the world. Moving on, if a country sold more goods and services to the rest of the world than they purchased from other countries, they have a trade surplus. That is fundamentally the definition of a trade surplus. They sold more than they bought. They have extra money lying around. If the balance of payments on the financial account is $25 and the balance of goods and services is negative 20, the statistical discrepancy of the financial account is $2. This question is weird and it makes me want to shut off my brain. Then they ask us what the net international transfer payments, blah, 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 blah. Let me just tell you right now, the net international transfer payments is just a function of the current account. So they gave us an incomplete set of information. The current account is the blue line. It's the balance of payments of goods and services, and it is the net international transfer payments. So essentially the question is just trying to test if you know the basics of this equation. So if the current account is goods and services plus transfer payments, we're essentially dealing with a situation where to get the current account, we have to take this negative 20 and we're essentially adding some number to it. Well, I better back up a little further. Whatever number goes in there is automatically going to be negative. So that's another little bit of a trick to this question. But if the balance of payments on the financial account is 25, I'll use red to talk about the financial account. They're telling us that the financial account was $25 and it had its own discrepancy of 2. So the financial account is in some essence already 27. Then we're adding that to a current account that is traditionally always negative. And that current account had this value of 20. And somewhere in the current account has to exist the net transfers. Let me actually bundle this a little bit better. Because the net transfers are already subtracted, I'm actually going to turn this into a minus. So you kind of understand that if the transfer payments are out, they're automatically negative. If the transfer payments is negative, that would be saying money coming into us. But for the current account, it's essentially money leaving. So that's a weird double negative that exists there, but it'll be important for the next step that we're taking. Can't seem to get rid of this baby, so I'm just going to delete it. Does not want to be deleted. All right, so this is my equation. I know that that equation becomes 0. So the only way I can solve this equation and make it equal to 0 is to use a 7 in this context. So the international transfer payments came out to $7. American retailers import toys from China. If we bring in toys tells me already it definitely has to be the current account. The US balance of payments. So let's work this out. If we bought toys from China, we made a payment to a foreigner. So it's a payment to a foreigner in the US current account. Let's take that another step further and try number 6. The US exports corn. Well, that corn was the immediate giveaway that it's current. There's no such, I don't even know what the heck that answer is. So that has to be current. Then it's asking us for the US balance of payments. Well, if we're giving corn to other people, people are paying us. So it's like we're getting money from foreigners and it's going into our current account. Take it a step further. Microsoft, it's a Seattle company. It purchased an office building in Vancouver. I'll tell you this, if you purchase an office building, you are investing in that building. So in the US, the balance of payments account, this would be entered as, well, I just said it was an investment, didn't I? So an office building investment is definitely the financial account. Then, because we bought the office building in another country, that is technically a payment of foreigners, but it shows up in our financial account, which helps balance the books. Number 8, an American deposits $10,000 into an account in a London bank. In the US balance of payments, this would, okay, let's keep it going up. We just deposited $10,000 into an account in a bank. That sounds an awful lot like an investment to me, a financial investment. So the US balance of payments, well, money left the United States. So that would cause the balance on the financial account to decrease. Money left the United States. Number 9, suppose that any international capital flows, prior to any international capital flows, in the US, the equilibrium interest rate is 3%. So in the US, we're not doing too good. 3%, that's not great. In Japan, it's 7%. Well, I don't even have to read further into the problem. I can tell you, if I can get 7% on my money in Japan, I'm going to start turning my money into the yen and start investing in Japanese businesses. I want that 7%. So we would expect capital to flow from the United States to Japan. And what that's going to end up doing is that will actually increase the supply of yen. So over time, that would actually decrease interest rates in Japan. And on the other side, because we're turning American dollars into yen, there's a decrease in the demand for dollars. Excuse me. a decrease in the supply of US dollars, so that would raise the interest rates in the United States. So looking at this question with a little bit more attention, the capital flow from the US to Japan is increasing. So it's definitely capital to flow from the US to Japan, so it cannot be B or C. And then we would expect that interest rates would increase in the United States and decrease in Japan. So I'm going to have to scroll just up a little bit so you guys can see it. It would be capital flow from the US to Japan, which would effectively decrease interest rates in Japan and increase interest rates in the US. So it's answer D for sure. Suppose that the rate of interest in the United States is 4% and in India it's 7%. This assumption is necessary for capital to flow, so it's just part of everything we'll ever see. If that's happening, eventually things are going to take place. Interest rates in the US will increase further as compared to interest rate in America. Why does that happen? Well, because eventually people start giving their dollars, trying to turn them into the Indian currency, and effectively increasing the supply of Indian currency, increasing the demand for Indian currency, but the decrease of supply of US currency would eventually cause US interest rates to rise. If asset owners in Japan and the United States consider themselves substitutes, meaning you can freely trade, it's just another one of those assumptions, and the US interest rate is 5%, and the Japanese interest rate is 2%, then all of the following things will occur except, and hopefully they will all make sense. The financial inflows will reduce the United States interest rates because everyone's trying to put their money in the United States. Financial outflows will increase the Japanese interest rates. Pretty much the fundamentals of what we're talking about here. The interest rate gap between the United States and Japan will eventually be eliminated. In the long run, that's pretty much also what we're trying to describe will happen. The loanable funds will be exported from the US to Japan. So we'll take it one step further and we'll read the last one. The interest rate in the United States will equal the interest rate. Well, C and E are both correct. So it definitely can't be those. So it looks like we're back at a place where we definitely have the answer at D. And let's make sense of it. The loanable funds will be exported from the US to Japan. That's like saying we're just sending money over to Japan. But it's actually the opposite because the Japanese interest rate is 2%. They actually are trying to take their loanable money and move it to the US where their interest rate is high. But it's really worth saying, like you can memorize things like A, B, C, and E because they're back. Use the graph below to answer question 12. So here they're asking us if the actual interest rate is greater than 4%. So I'll just draw some arbitrary line. If the actual interest rate is greater than 4%, the quantity supplied is greater than the quantity demanded. Hopefully we can see that on the curves. Quantity demanded, quantity supplied. What a beautiful, beautiful thing. Quantity supplied. So the quantity supplied is greater than. And that's going to be really important for answering the next two questions, and this will be the end of the video. Trying to finish it before 20 minutes. Just missed it. So here, assume that each country's loanable funds market is such that the equilibrium interest rate is 4%. So that's saying right now this is the equilibrium interest rate for these countries. Just exists, nothing we can do about it. Assuming that assets and liabilities are homogeneous, in order for them to trade with each other, that has to be true. What's the next logical step for reconciling this apparent disequilibrium? So in one country, in the US, 4% is below the equilibrium. So at 4%, if that's the world price, then it's like saying in the United States, they will supply fewer loans at 4% than are demanded. A lot of people in the US would love to take out a loan for 4%, but they can't. Not that many banks supply them. The equilibrium in the United States is here, but globally it doesn't allow them to set the prices. Let's look at that from the UK's perspective. If someone in the UK found out that they could get a 4% interest rate, there is not as much demand as there is supply. That supply is really the key word there. There's, in the United Kingdom, a greater supply at 4% than there is demanded. In the United States, at 4%, there is a greater demand than there is supplied. So there would probably be a capital outflow from the place where they can't get as many loans as they want to the place where they can get much more loans at that quantity. So money would leave the United States and enter the United Kingdom. There will be a capital outflow from the United States to Great Britain. So where are we in the answers here? There will be capital inflow from Britain, capital inflow from the United States. So if money starts leaving the United States and entering Great Britain, we're going to put ourselves in a situation where the interest rates rise. Yep, just checking my answers here. So, one other time, there will be a capital outflow from the place where people cannot seem to afford to get a loan at that ideal interest rate, and that would effectively start lowering interest rates in the United States. So just explaining what happens one more time, money is moving out of the US. This is the loanable funds market, because right now in the US, you can only seem to really get like a 6% interest rate loan. And if people heard that you could get that same loan at 4% in Great Britain, money is moving out of the US, or certainly there'll be a capital outflow out of the US into the United Kingdom, which would eventually depress interest rates because the supply of money changes. And just for the sake of time, I'm going to try to get the last answer here too. At an interest rate of 4%, the excess of loanable funds, so the excess of loanable funds is coming from Great Britain right over here. These guys have a surplus of loanable funds. They can't seem to get rid of their supply of loanable funds at 4%. Will be exported, will be supplied by British lenders and exported to the worldwide market. Americans will certainly be taking advantage of it, but it's very likely other people will as well. So, boom.